In this video, tax on international real estate for Americans. This is something that I'm personally very curious about because I spend the entire year traveling the world. I spend less than 30 days a year in the United States in order to get the tax benefits, obviously. And so I see a lot of international real estate deals, and I'm curious kind of how that would pan out from a tax perspective, both in the US as well as in the local country, and the dynamic of both countries with double taxation and so forth. So in this video, we're going to dive into the topic that's probably on the minds of many Americans investing or thinking about investing abroad: taxes on international real estate. If you own or consider owning property outside the US, it's crucial to understand how taxes work. It's going to save you a lot of headaches. It's going to save you a lot of money. So stick around because we're going to break it all down as best we can. So first, let's understand international real estate taxation. So just to get one thing straight, just because your real estate is abroad doesn't mean Uncle Sam is not interested. As a U.S. citizen, you're taxed on your worldwide income. This means that any rental income, capital gains, or profits from selling real estate overseas are reportable to the IRS. It's part of the deal when you're a U.S. taxpayer living or investing abroad. They want a piece of everything. So you may be thinking, do I have to pay taxes twice, once in the country where the property is, and then again in the U.S.? And well, like most questions, it depends. But let's break it down and make as much progress as we can in this video. And by the way, I own property internationally. At MyLatinLife, we've helped dozens of people invest in property internationally in Mexico, Argentina, and all around Latin America. So it's something that we're actively interested in and going to probably pursue to a greater degree in the future. So kind of just satisfying my own curiosity here. But if you are interested in working with MyLatinLife, either on the real estate thing, you want some introductions, you want tax lawyers, you want real estate agents in Latin America, book a call with us. It's the best way to become a client. Speak with me directly, and we'll set you in the right direction. Okay? So first topic here I want to talk about is reporting the rental income. So if you rent out international property, the income you earn from that is taxable in the U.S. That rental income must be reported on your U.S. tax return, just as if you were renting out property in the U.S. But here's the good news. If you're paying taxes on that rental income in the country where the property is located, you might be able to offset some of your U.S. tax bill using what's called the foreign tax credit. This credit helps you avoid double taxation. Now, just like with U.S. properties, you can deduct expenses related to maintaining the rental property, such as repairs, insurance, property management fees, and even depreciation. So that's good. Keep track of your expenses on your international properties. They're deductible against your U.S. taxes. Next, I want to talk about capital gains, right? Capital gains on selling international property. What happens if you decide to sell that property abroad? Well, any capital gains from selling international real estate are subject to U.S. capital gains tax. How much you owe will depend on how long you've held the property and your income bracket. For properties held for over a year, you'll typically pay long-term capital gains tax, which is usually shorter than short-term rates. Again, if you've paid taxes in the country where the property is located, you might be able to use the foreign tax credit to reduce your U.S. tax liability. Another thing to keep in mind is that the foreign earned income exclusion, which allows you to exclude a certain amount of foreign earned income from U.S. taxes, doesn't apply to capital gains. So any profits from selling real estate will be fully taxable by the IRS. Next, let's talk about FBAR and FATKA compliance. Now, if you're serious about international real estate, You've probably heard of FBAR, Foreign Bank Account Report, and FATKA, Foreign Account Tax Compliance Act. These reporting requirements come into play if you hold foreign bank accounts to manage your property. If you have a foreign bank account that exceeds $10,000 US at any point during the year, you must file an FBAR. Okay? So if it crosses that 10K threshold, even one day during the year, you got to file that on the FBAR report. And under FATKA, if your foreign financial assets exceed certain thresholds, you'll have to report those too. FBAR and FATKA don't directly impact your tax bill. It's really just reporting. It's not a tax inherently, but failing to report can lead to hefty penalties. So make sure you're on top of these reporting and filing obligations. Next, let's talk about foreign property taxes, right? Many countries have their own property taxes. You will find, though, in Latin America specifically, property taxes are way lower than in the US. Like, so low. Like, in Mexico, your annual property taxes might be $100. I'm not joking. In El Salvador, there's no property tax. So every country and jurisdiction in Latin America is a little bit different, but just know that property taxes are much lower, typically almost anywhere in Latin America compared to the US. And these vary widely depending on the country and sometimes even the region within the country. And in most cases, property taxes paid abroad are not deductible on your US return. However, they might help reduce your overall taxable income in the foreign country. Make sure you understand the local property tax laws and pay any required taxes in the country where the property is located. Staying compliant with foreign laws is just as important as staying compliant with US tax laws. Remember, if you're not filing correctly in the country where the property is located, they could seize the property, touch wood, but obviously you got to be on top of it in the local country, and then you got to be on top of it in the US. Unfortunate that foreign property taxes are not deductible in the US, but usually it's pretty low anyway. Next, let's talk about some common pitfalls to avoid when it comes to international real estate. So a few common mistakes Americans make when dealing with international real estate is not reporting foreign rental income. Remember, all worldwide income is reportable, even if you don't bring the money into the US. Another mistake is failing to claim the foreign tax credit. If you pay taxes abroad, don't miss out on this valuable credit that can offset your US tax liability. Another mistake is overlooking FBAR and FATKA requirements. These reporting rules are serious, and penalties for non-compliance can be severe. Owning real estate abroad can be a fantastic investment or lifestyle choice, but it comes with tax responsibilities as an American that you cannot ignore. Understanding the tax implications on rental income, capital gains, and property taxes is key to making smart, informed decisions. If you're ever unsure, it's always a good idea to consult a tax professional with experience in international taxation. So I hope this video was helpful in terms of shedding some light on your obligations when you buy rental property and real estate abroad as an American. And if you enjoyed this video, give us a thumbs up. But particularly on this video, I want to hear from the audience. If you've bought real estate abroad as an American, please comment below. I'd honestly love to hear your story, and I'd be happy to respond as well. I'll read every comment, I'll respond. So if you've bought real estate abroad as American, or you're interested in buying real estate abroad as American, we want to hear from you. Don't forget to subscribe to the channel for more tips on international living and investing, and we'll see you in the next video.